Have you ever wondered what really happens before a financial crisis? It's not just about stock markets crashing or banks failing overnight. The warning signs are often hidden in plain sight, patterns and behaviors that consistently emerge before the economy takes a dramatic turn. In today's video, we'll break down these critical indicators, explore their impact, and share what you can do to safeguard your finances during uncertain times. Let's start by clearing up the confusion between recessions, bubbles, and financial crises, terms that often get thrown around interchangeably but mean very different things. Historically, episodes such as the 2008 financial crisis and the Great Depression highlight how a specific trigger, be it a collapsing housing market or a massive stock market crash, can ignite broader economic turmoil. In 2008, subprime mortgage lending and the creation of complex financial instruments like mortgage-backed securities led to a surge in housing demand and prices. As soon as housing values peaked and began to fall, banks and other institutions holding these risky assets faced crippling losses, igniting a credit crunch that reverberated around the globe. Meanwhile, the Great Depression was rooted in the exuberance of the 1920s. The period, known as the Roaring Twenties, was marked by a booming stock market and speculation that drove equity prices well above their actual worth. When the bubble burst in 1929, the sudden evaporation of wealth triggered widespread bankruptcies and an almost decade-long economic downturn. Each crisis emphasized how systemic risks, excessive leverage in 2008, and unbridled speculation in 1929 can turn a localized problem into a global catastrophe. Another layer of complexity in financial crises arises from asset bubbles and the role of debt. An asset bubble takes shape when the price of a given asset, such as stocks, real estate, or technology companies, rises steeply and not in line with economic fundamentals. Investors get swept up in these surges, assuming prices will keep escalating, which only fuels more demand. The dot-com bubble of the late 1990s is a textbook example. Tech companies, many with no real earnings or viable business models, were valued at extraordinary levels because of widespread belief in limitless future growth. Once confidence eroded, stock prices collapsed, wiping out trillions in market value and triggering a mild recession. Closely tied to this phenomenon is the problem of debt. Debt-fueled speculation, often involving people borrowing heavily to invest in assets with inflated prices, acts like a multiplier. When times are good, returns appear lucrative, but if prices fall suddenly, the debt burden becomes insurmountable, catalyzing defaults and bankruptcies. This interplay between bubble psychology and debt underscores the precarious nature of many financial systems. Speculation itself drives many of these issues. Historical instances of speculative manias, such as the tulip mania of the 1630s, illustrate how quickly crowd psychology can inflate prices to unsustainable levels. During tulip mania, certain rare tulip bulbs were traded at values higher than that of homes, buoyed by the assumption that the price could only go up. When reality set in, the crash was severe, causing profound financial distress. The dot-com period followed a similar arc, albeit with high-flying internet startups rather than exotic flowers. The key element tying these events together is irrational exuberance. When investors see rapid gains, the fear of missing out compels them to jump in, ignoring fundamentals in favor of chasing quick profits. This herd mentality further disconnects asset prices from their intrinsic value, increasing the vulnerability of the market. The moment negative news or a shifting sentiment breaks this cycle, prices can free fall, underscoring how psychological factors, confidence, optimism, group behavior, play a central role in crises. Besides speculation, it is crucial to understand the structural markers that often warn of a looming financial crisis. Many experts look to broad economic indicators such as the Leading Economic Index, LEI, to spot early signs of recession. The LEI aggregates data from components like weekly hours worked in manufacturing, new orders for consumer goods, building permits, stock prices, and interest rate spreads. A consistent downward trend in the LEI can suggest an economic slowdown, hinting that a more serious contraction may be on the horizon. Of course, no single index can perfectly forecast recessions, but the LEI, combined with unemployment trends, inflation rates, and consumer confidence measures, can provide a composite view of economic health. Identifying trouble in advance allows policymakers and businesses to mitigate potential damage, perhaps by adjusting interest rates, rolling out fiscal stimuli, or reevaluating investment decisions. Taking a broader historical perspective, the Roaring Twenties and subsequent Great Depression showcase how short-term prosperity can lead to long-term destruction if not managed carefully. After World War I, the U.S. experienced massive economic expansion and technological progress, culminating in speculative trading on the stock market. The euphoric rise of stock prices lacked solid grounding in corporate earnings, and the collapse that followed the 1929 crash wiped out years of gains, thrusting the economy into a protracted depression. This downturn led to important regulatory developments like the establishment of the Securities and Exchange Commission, SEC, and the Glass-Steagall Act, instituting a firewall between commercial and investment banking to reduce systemic risks. Analogous to the 2008 crisis, these reforms aim to address the core problems of excessive speculation, lack of transparency, and inadequate regulation. When we move beyond macroeconomic patterns to personal finance, the lessons gleaned from past crises are equally instructive. One valuable rule is diversification, spreading assets across stocks, bonds, real estate, and commodities. This approach prevents the extreme losses that can occur when one asset class plummets. The meltdown of certain tech stocks during the dot-com bust, for instance, had less dire consequences for those who also held positions in stable bonds or real estate. Another critical rule is caution about leveraging or using debt for speculative bets. While leveraging can magnify gains during a boom, it can also accelerate losses in a downturn, as the burden of repayment remains constant even if the asset's value collapses. A compelling example is the housing market before 2008, when borrowers stretched themselves thin with subprime loans, only to face foreclosure when home prices fell. Vigilance about one's own debt levels and a clear-eyed view of potential returns can prevent being caught in the center of a financial maelstrom. Alongside these economic and psychological facets is the role of confidence. Crises often hinge on abrupt shifts in sentiment, where the optimistic view that prices will keep rising transforms into a fearful dash for the exits. This confidence can crumble for various reasons: a surprise interest rate hike, political turmoil, corporate scandals, or even changes in global trade policies. Confidence, while intangible, is arguably the lifeblood of financial markets. Once it drains away, liquidity tightens, banks grow more cautious, and a downward spiral can ensue. Because of this, market watchers pay close attention to indicators like consumer sentiment indices, credit spreads, and yield curves. A flattening or inverted yield curve historically has been a particularly strong sign that investors expect slower growth or a recession in the near future. One more vital aspect to consider is policy overreach or underreach. Loose monetary policies, such as low interest rates and quantitative easing, can set the stage for bubbles by making credit cheap and boosting appetite for risk. If this environment persists too long, asset prices can become detached from reality. Conversely, overly strict policies, like sudden rate hikes, can shock a market built on easy credit, sending asset values tumbling. Likewise, insufficient regulation can embolden risky behaviors, while overbearing regulations could stifle legitimate growth. This balancing act is an ongoing challenge for central banks and governments who strive to maintain economic growth without allowing speculative excess to spiral out of control. When discussing crises, it's also useful to examine the role of structural imbalances and global linkages. The 2008 crisis illustrated how interconnected global finance had become. A housing crash in one country quickly reverberated worldwide, partly due to the complex web of mortgage-backed securities and derivatives. Institutions across different continents found themselves exposed to the same toxic assets, leading to a domino effect. This interconnectedness underscores the necessity for international cooperation and transparency. A crisis originating in one market no longer remains contained. It crosses borders rapidly. That's why organizations like the International Monetary Fund, IMF, advocate for consistent financial regulations and the free exchange of information among different countries. The modern system is too integrated to allow one major economy's meltdown to stay localized. Even though crises may appear inevitable, there are ways to protect oneself and mitigate their impact. Along with diversification and avoiding speculative leverage, cultivating financial literacy is paramount. Understanding how markets function, the purpose of monetary policy, and the significance of economic indicators fosters more rational decision-making. Regularly reviewing one's financial situation, be it retirement accounts, emergency funds, or investment strategies, can ensure readiness for the inevitable downturns. There's also merit in being attuned to global events. Political tensions, trade wars, or a pandemic can trigger sudden shifts in economic confidence. Being aware of these triggers helps in making timely and informed adjustments. Safeguarding personal finances goes beyond just looking at stock prices or housing markets. It also involves building an emergency fund to cover several months' worth of expenses, maintaining adequate insurance, and considering robust estate planning for long-term security. Through consistent saving and careful planning, individuals can weather even severe downturns. Meanwhile, from the policymaker's standpoint, preventing crises involves prudent regulation, close monitoring of leverage and speculative markets, and readiness to intervene if systemic risks arise. For example, central banks might tighten monetary policy when they detect bubbles forming, though timing is often delicate and subject to criticism. To wrap up, financial crises always carry certain familiar hallmarks: surging asset inflation, heavy reliance on debt, widespread speculation, and an eventual collapse triggered by a loss of confidence. Recessions, bubbles, and crises each showcase a different angle of financial instability, but they often converge to produce severe economic pain. Over time, economies display cyclical patterns, making a well-grounded historical perspective invaluable. The Roaring Twenties ended with the 1929 crash and Great Depression. The dot-com boom climaxed with a crash in 2000, and the housing bubble of the mid-2000s climaxed in the crash of 2008. Each crisis left behind lessons that, if heeded, could reduce the devastation of the next cycle. Crucially, vigilance is key. Keeping track of indicators like the leading economic index, understanding the behaviors propelling market psychology, and acknowledging the roles of government policy and global linkages can alert observers to building risks. Armed with these insights, stakeholders can prepare in ways that mitigate harm. For individual investors, a discipline of diversification, prudent use of credit, and avoidance of speculation is the surest safeguard against market ups and downs. For policymakers, implementing intelligent oversight, timely interventions, and transparent communication can preserve confidence. With all of this in mind, it's clear that while recessions, bubbles, and financial crises are connected, they're not identical phenomena. Recessions typically point to a downturn in overall economic activity. Bubbles refer to unsustainable spikes in asset prices, and financial crises involve rapid, system-wide disruptions. Recognizing these categories and what usually precedes them can help us see the warning signs: hyperinflated markets, surging leverage, waning fundamentals, and psychological biases that lead crowds astray. In the cyclical dance of boom and bust, the cyclical patterns are strikingly consistent, pointing to a repeated narrative of overreach followed by collapse.